So I'm going to kind of start this with, as I do with Barry, which is to say a lot of people go, okay, well, now I've heard this argument for 2 or 3 or 6 months or 9 months or what have you, and kind of when is the apocalypse coming?
Well, the apocalypse can't come until the debt actually is maturing. And we've got about $6.5 trillion of corporate debt maturing in the next 36 months. Not a lot in the next 6 months. So most companies have done a pretty successful job of kicking the can down the road and refinancing over the last couple of years when they've been able to. And we've had an incredibly conducive market environment that has allowed companies of all credit qualities and all types and sizes to be able to raise capital. And they've done it, some of them with impunity. But it has really put the maturity problem further out. So we're really looking at getting into 24 in through 26 when we're going to see a lot of maturities coming due that companies are going to have a harder time refinancing or paying off.
And the other thing I wonder about, it's almost a little bit hidden, but, you know, the bottoms-up analysts look at this very closely where they go, okay, well, maybe this company was able to refire it. But like once you're paying that higher rate, and that's putting the squeeze on the business for a couple of years to come, you know, so even if you can get it done, you do wonder about what that means for operating expenses for, you know, the 2, 3, 5 year period, whatever it is.
Well, and absolutely. And we're still in a period where a lot of companies are trying to recover from the COVID period, and all of that extra capital, government funding and financing, as well as ability to borrow, has masked the problems of operational degradation for a lot of companies. We've seen in our financial health ratings deterioration in a lot of different industries, and in particular in a lot of private companies. And in private companies that are generally speaking going to be floating rate borrowers, they're the ones that have been hit the hardest with rates increasing. So everyone needs to pay very close attention to what the larger companies who are generally speaking more fixed rate borrowers are doing, but also what the private companies that are floating are that are associated with them.
And perhaps going into earnings season, it's a reminder, it's really not all about what the largest 500 companies in America tell us who are able to tap that more fixed rate financing or don't have as big needs when the rest of the economy is comprised of a lot of these smaller firms. Last time you were here, we spoke about some concerns in the auto supplier market, for instance. Where else do you see, it sounds like even in tech, where we've had kind of a banner year for the publicly traded names, there are some cracks.
Well, first, you're absolutely right. No company operates in isolation. It operates in an ecosystem of counterparties, suppliers, customers, trading counterparties, all kinds of other businesses. And roughly 75% of most Fortune 500 companies' suppliers are private companies. So just to put in perspective just how important that sector really is. But we're seeing problems in a whole variety of sectors, but I would not just take things in terms of industry. I would look in terms of sizes of companies in those industries and the mix of public and private. Because again, with 75% of companies' suppliers being private, you've got to look upstream and understand what the dynamics are that are affecting them. Autos is one, defense and aerospace, retail. We're seeing drugs and pharma and health products, as well as technology. And I put technology as sort of last because it's particularly interesting. You've got the largest tech companies in the world have been doing great, really bolstering a bull rally for the course of the year. Not every day, but for the course of the year. But underneath that, you've got companies that have been seeing their customers' budgets get contracted. And they're getting contracted because customers' budgets are concerned, or customers are concerned about general economic conditions and how their own business is going to look over the next 6, 12, 18 months, and that's starting to flow through.
It sounds like you're echoing some of what Barry said when he saw a slowdown, notices one in smaller size firms and their hiring plans and that kind of thing. So do you think at some point, what happens typically? Does this bubble up to the biggest companies at some point, or what typically happens throughout the cycle?
Well, you're seeing the squeeze, right? So the smaller companies, the medium-sized companies, they're suffering higher labor costs, they're suffering higher interest expense, they're suffering parts inflation, and they can't always push those costs through to their larger counterparts. So you end up downstream with the largest companies continuing to do reasonably well, but having the strength and the wherewithal and the resilience to be able to handle that period of time where everything is bunching up in the middle. And that bunching up in the middle tends to happen with the smaller public companies and a lot of the private companies. So this will flow through eventually, but we've already seen a 70% increase in default rates and bankruptcies this year over last year, and we're going to see a lot more of that. I think right now it's around 6 to 1 private companies to publics. And that will continue, and we're going to see a significant increase in defaults, particularly in mid-size, mid-cap, and smaller private companies.
Real quickly, I want to mention Carvana, which we spoke about last time when you were talking about its deteriorating financial profile, and it's emblematic of this market this year in many ways. This was a $3 stock at the 52-week low. It's now at 30. There's so much short interest because of some of the problems you mentioned that it keeps popping every time they talk about being more cash flow or whatever it was positive the last couple of weeks. The shares are up another 8% today. What does this tell you?
There are a lot of people looking to make money on momentum. And today, I think Carvana announced that they expected to have greater sales from EV products. Well, that's not a surprise. There's more EV out there. But Carvana is not a company that's going to operate its way out of its problems. It has an incredible debt load.